Let's talk about how to win in the self-storage industry 2020 and beyond. Today we're going to look at the third critical area in a series of 5 that our company is really focused on right now as we prepare for the balance of this year and how to really thrive in 2021. And today we're going to talk about some revenue management systems. My name is Mark Helm. I'm the author of Creating Wealth Through Self-Storage, and I'm the creator of the Self-Storage Quick Start Academy. And I support the small investor who wants to get in the self-storage business or who wants to grow their self-storage business, strategically do so in a way that creates true wealth and a fulfilling career. And as we move into this, quote, new reality, it's really critical that we, based on what's going on in the economy and what's going on in our industry, that we really focus on some key areas. We're going to talk about the third area in a series of 5. If you haven't watched the ones before this, there'll be a link below to see those as well. But I feel these areas are critical for every storage owner to really be focused on right now, particularly if you're a small investor, because these areas, in my opinion, are the difference between not just making it over the next year, but actually being able to thrive in the next 12 to 24 months. And I've talked about revenue management systems before. I see 4 basic types of revenue management systems today. One is dynamic pricing. The next one is value pricing. Then we have customer-centric pricing or value enhancement models. And then we have ancillary income streams. So let's talk about dynamic pricing. We've touched on this in a number of episodes, but dynamic pricing is basically the price of your unit is determined usually by a computer algorithm, and it's based on your sub-market, occupancy rates in all the facilities, occupancy rate in the unit type, 10 by 10s in your sub-market, the seasonality of it, and some other variables that the computer will look at to generate what it thinks is the best pricing today for that facility. If you're flying or if you're staying at a hotel, the price you're paying for your ticket or your hotel room usually is a function of dynamic pricing based on how empty or full the hotel room is, whether it's a weekday or weekend, what time of the year it is. If you're standing in line at Disney World, even Disney World now uses dynamic pricing. You've probably paid a different entry fee than the person in front of you at Disney World, depending on when and where you bought your ticket. Now, as I've stated before, I've always felt that for a subscription pricing model, which in many ways storage is that, it's a monthly reoccurring charge, dynamic pricing has some inherent flaws with it. But that's just my philosophical view on it. That doesn't mean it's right. And there are many people, probably smarter than me, that are successfully using it. Now, we're currently not using it, and we use the fact we're not using it as a differentiator between us and our competition. Why? Well, we're usually in markets where REITs are, or larger players, and those players use it. And when you have dynamic pricing, what happens is there's usually a lot of price increases. And we take advantage of that, or attempt to take advantage of it. And very often we're able to snag people who are at facilities now that they've now had 2 or 3 price increases in less than a year or so, and we're able to get them to move into our facility simply because we get in front of them online. However, perhaps our overall revenue would be higher if we did dynamic pricing. Nothing's off the table right now. Never say never. We're looking at it with fresh eyes to determine if dynamic pricing for us is a way to go now. And when we talk about concessions and move-in concessions, I think this falls in this category here. We look at what our competition in the submarkets are offering for move-in concessions, and we tailor many of our concessions based on what we see going on in our submarket. Really, the only difference between dynamic pricing and the concessions is usually dynamic pricing is generated by a computer algorithm telling you what your unit price should be for that day or that week. And concessions, we make that determination ourselves. So this is one area to really begin to focus on and learn about as a potential revenue management system. And then there's value pricing, and we've talked about that before too. Value pricing is based on the premise that not all 10 by 10s are created equal. A 10 by 10 close to the gate or close to the office, or a 10 by 10 that's close to the entryway in an interior building or next to a lift in a multi-story building. The premise is that 10 by 10 is more valuable than a 10 by 10 at the back of the facility or at the back of the hall. Now, I've learned the hard way that your effectiveness at using value pricing is a function of are your managers sold on using it, or are your partners sold on using it? It's kind of like tenant insurance. If there's not a lot of energy around it, you're not going to get many results. If you are, I've seen value pricing add 15 to 30% more to the bottom line with the same level of move-ins and move-outs. It can be a real enhancement to your cash flow. And basically it just works whatever your street rate is, that's the lowest price point for, let's say, a 10 by 10. Your street rate for a 10 by 10 is your lowest 10 by 10. As we're showing people, we don't advertise our upgrades on the websites, but as we're showing a person the 10 by 10 and we walk by, we tell them that here's another 10 by 10. It's more expensive because of where it's located, but this is the exact same size unit that you're going to see at this price. Think about it. If you're sitting in the gate of an airport and you have the chance to upgrade to first class on a 3-hour flight to Las Vegas and you live on the East Coast and it costs you $50, would you pay the $50 for that upgrade? Well, a certain percentage of the population will. Those are the people who would pay more for the 10 by 10 closer to the gate or closer to the where they park their car when they're unloading. Some people will never pay it, and that's fine. We have units for them too. But if you can take advantage of the percentage of the population that will pay more for convenience, that does nothing but go straight to the bottom line. So really explore looking at value pricing. You can create that yourself, or there's computer programs which we use that integrate with our operating software so that nothing has to be entered by a manager. Unit 10 is the street rate, unit 1 is the upgrade, and the pricing is already laid out for the manager, and it's in the computer and they have to do nothing. They just point the upgrades out as they're given the property tours to the customers. Look at using value pricing. The third area of revenue enhancement models are more customer-centric driven. And we're really putting our toe into this. So for example, according to some data that I've seen, actually it was a speaker at the 2018 SSA conference, A customer who's been at a facility for over a year is 50% more likely to absorb a price increase than someone who hasn't. Customers that are on auto pay are 30% less likely to complain or to move if they have a price increase. So there's all types of how customers behave, and adjust your pricing model to that behavior. Now, some of this might be counterintuitive. For me, for example, it would seem the longer a customer would be at your facility, the less they would pay for a 10 by 10. But when I voiced that, it came back to me, why? That's just what you think. What if that customer's willing to pay more for a 10 by 10 the longer they're there? Don't you owe it to yourself and to your investors to get the most you can for that? So we're really beginning to explore and look at this. So we know, for example, that customers on auto pay are less likely to move out and are less likely to complain when there's a price increase. So we want to incentivize auto pay. Perhaps you could say that the quoted street rate is assuming that you're going to be on auto pay. If you're not on auto pay, it's $5 or $10 more a month. That would incentivize a customer to select auto pay. Or you could incentivize your managers. If you have employees working, have the bonus to the employee be contingent on what percentage of auto pays in the new move-ins they get. Bonus the employees based on what the customer-centric behavior you want. And what we're seeing is there are certain customer behaviors that will allow us to have higher prices for those customers. We're really beginning to explore and look seriously into that and to test it out. And then the next area is ancillary, or adding profit centers, ancillary income, or adding profit centers that aren't currently there now. Now, for us, the big one has been tenant insurance. We're now at the point where you've got to have insurance on your items if you're storing with us. Our tenant insurance is on your bill. Now, you have 30 days to show us that your homeowner covers it, and we'll remove it. But if you're going to store with us, it's got to be insured. Now, by the way, you don't want to use your homeowner's insurance. If there's a claim, you don't want your home insurance going up for years, and you believe me, tenant insurance is the way to go. Or they can get other renters insurance. But we're generating significantly more income now by creating that as a feature for us, rather than just trying to sell it to people as they move in. Now, perhaps it might be truck rental for you. You know, we have some facilities where we get thousands and thousands of dollars a month in truck rentals. If you're not doing it, explore that. It might even be retail sales for you. Our philosophy is, if somebody's going to put a lock on their unit or buy a lock for their unit, we want to be the ones to sell it. I've even said I will sell TVs if they'd buy them, half jokingly, but I probably would sell TVs if people would buy them. The way we're looking at these ancillary income streams is it's got to be somewhat related to storage. Tenant insurance obviously is. The retail items we sell are. Trucks are related to storage. So we're looking at all the areas that we can increase or add to it. And that's one of the reasons we went to making tenant insurance mandatory. REITs are doing it, but we decided to do it because we think it's critical to have that in place as we move into the next 12 months. I'd be real curious what ancillary income streams you may be looking at or exploring or have recently put into place that have helped you out. So as you move into the next 12 months, as we go through the rest of 2020 and into 2021, revenue management systems are going to be critical because we may not be able to impact our lease-up rate or impact our occupancy rate a whole lot during this time period. And what if you can add 5, 10, 20% more income to the bottom line with the same occupancy level? Would it have been worth the energy and effort you took to explore this? I'd say yes. And also, it would increase the value of your asset. So really, now's the time. If you've been putting off looking at some of these revenue enhancement models, now's the time to do it. So thank you very much. I look forward to being with you next week, and we're going to go into the fourth key area that you've got to put some attention on for the next upcoming year or so. My name's Mark Callum. I'm the author of Creating Wealth Through Self-Storage, and I'll see you next week. I look forward to being with you then.